Good afternoon, everyone. Welcome to Hit the Bid here on February 8th. This is Jai Robbie here through Week 6 Market Watch. Today we're going to run through our charts and see what happened in the market over the last week, see what we can look forward to as we head into Week 6. So let's jump in and get started. First up today, we got our April live cattle on the board. Did see pretty mixed action here in the cattle market last week. Big swings both ways before finishing the week basically unchanged here on this April live contract. Did see price opening up here on Monday, seen a nice rally here throughout Monday and Tuesday session. Some of that momentum spilled over into Wednesday as well, as we did see a nice rally off that opening range on Wednesday up into new yearly highs, coming in right here around 244.5. However, Wednesday we weren't able to see those bulls hold those higher prices, and we did see that sell off into the close as this market did settle back down here near the lows. Bulls didn't really have much of a chance to defend those lows here as we headed into Thursday's session. We did open up with that gap and go to the downside, price opening up down here and running all the way down into our major moving averages. Seeing an uptick in volatility here over the last couple days of the week. Friday's action, we did just see nice back and forth here as it chopped up, trying to digest some of this volatility over the last couple days. We continue to see this market trading in bullish territory. We still got a nice uptrend here that's shaping up, still holding above all of our key levels and our major moving averages, which is a good sign for the bulls. At the moment, though, we do see a little bit of a sell-off here late this week on some heavy volume and some uptick in volatility, so we want to be aware of that and respect that. This market, like I said, still remains in a good uptrend here, and we still do expect to see good buyer support down here around our major moving averages and all the way down into the low 230s. As we head into Week 6, we need to see the bulls continue to defend some of these value areas over the last couple weeks, and especially this 20-day low here at 231.25. If the bears are able to push this market back down here below 231.25, that would push us back into bearish territory and signal a time to start getting defensive and cautious. In the meantime, though, we still expect to see good support down here into the low 230s, and until this level breaks, we should continue to see that support hold. Last week had some pretty wide ranges and some more volatility than we'd seen over the last couple weeks, but we continue to see this market hold these prior week value areas. This market still seeing good support down here between 235 and 237. We expect to see that action continue. Look for the bulls to continue to hold down here in this area. If last week's low does start to slip, we could come back all the way down here towards 231 to 232. We still expect to see good support down here in this area as we got those major moving averages that should be holding price here, and this market is trading above that 20-day low. Until this level breaks, this market continues to be in bullish territory. We want to see this thing settle down a little bit, see these ranges tighten up, and a little bit of stabilizing action here in this cattle market. This volatility is something we want to take note of and be aware of over the next couple days. We want to see this market tighten up and show some good supportive lines in the sand to trade around. And from there, we should see this market continue to chew back up into this area and try and attack this overhead gap. Just seeing a little bit of volatility off of some overextended levels here in the near term. This market has had a pretty impressive rally since that Thanksgiving week low, so we could just see this market trying to give back some of that and take a little bit of a breather here. We expect to see this market find support over the next couple weeks, but we do just want to be aware of some of these levels. That prior week's low right here on 234.5 is one we need to keep our eye on. And but the important one that we need to keep this market above for the bulls to stay in control is 231.25. If we do get a finish down here below this area, I encourage everyone to raise cash and get defensive. But in the meantime, we should see good support down here in the 230s. Wait for this market to stabilize and tighten up, and we should see this thing start to try and turn back higher once again. Next up, we got our March feeders on the board. Similar action last week. We did see that nice rally throughout Monday, Tuesday, and Wednesday's action up into this overhead gap. We weren't able to get that gap filled as we did still leave a little bit of room here between 373.5 up to 375. So we still have a little bit of this overhead supply to chew through. That weak finish we saw on Wednesday, this feeder market continues to show good relative strength as we are trading above the 20-day moving averages still, and we aren't seeing as much weakness as we are seeing over here in this live cattle market. However, we continue to see good uptrends here in both of these live and feeder markets. The relative strength, though, has kept this feeder market in a little bit more bullish territory compared to that fat market. Did see Thursday's action selling off all the way down to that 20-day average before bouncing into the close, and then we did see Friday's action opening up here back above Thursday's high, trying to come back up into that gap and just digesting some of that volatility we saw late last week. This market did finish positive on the week. As I said, we do see continued relative strength in the feeders compared to those fats, and this uptrend still remains intact. The 20-day low we need to defend here in this feeder market is 353.35. We want to make sure that the bulls are able to keep this market held up above that level. In the meantime, we do have a lot of wiggle room here, a lot more forgiveness here in this feeder market as it has been stronger. We could see some support all the way down into the 350s if we happen to pull back into this area. But at the moment, looking like this thing's just going to keep on climbing that 20-day moving average. As we did chew through that gap a little bit last week, we still want to see those bulls close that gap, and then from there it should be a pretty easy move on up into new all-time highs. We still expect to see this uptrend hold and this cattle market continue to push higher. Just want to be aware of this volatility here and be respectful of that over the next couple of days. Let this market kind of stabilize before you really see this thing start to go higher once again. Mostly, we're just going to be waiting on this live cattle market to stabilize and balance out and turn higher because this feeder market is still trading here just slightly off of those yearly highs and not far off from that all-time high. We still expect to see this feeder market lead this thing higher. Bulls are in good shape here, and we continue to see good support. Look for this market to keep on pushing higher throughout the month of February. Be ready for a little bit of volatility here if we do start to trade back down here towards our moving averages, but we still have plenty of support all the way down towards those low 350s. So we should see this feeder market continue to hold strong and start to see that live cattle market turn back up with it and see this thing continue to push up into these overhead gaps and potentially back up into new all-time highs. March corn futures on the board now. We did continue to see just some choppy action here over the last couple weeks. This market has just kind of seen a slow, steady drift back up into the prior range lows. We did see that big that big breakdown off that WASDE report back here on the 12th of January that pushed this market down into some oversold levels. We've seen this market kind of come up here for a little bit of a relief rally here, trying to take a breather after that big sell-off. Last week, we continued to see resistance up here all the way up towards 435 and this in our major moving averages as our resistance is coming down onto price. We did see Thursday's action finishing up there above that 50-day average, but Friday we did see that rejection of that 435 level, which were these prior swing lows and this prior range lows. Expect to see those bears continue to defend that line until we can really see a confirmation close above last week's high and this 435 level. We still expect to see the bears try and keep this market capped right here around 435. Look for this resistance to hold and try and push this market lower. If we get some offers early this week below our 20-day moving average and this 430 level, we should see this thing start to fade back down here towards this prior swing low. This will be target one for the bears here as they head back down towards 417. If we get continued selling pressure here early this week and below that level, we should start heading down here towards contract lows as well. At the moment, this 435 level continues to be the line in the sand for this corn market. Above it, we expect to see this range continue to trade. Below it, we expect to see this corn market continue to slip back down here towards the $4 mark. Look for the bears to be in control as long as we're trading below 435. That's going to be the important one, but a good spot to put your risk around and keep a good line in the sand in this corn market. Look for the downside to continue as we do see a little bit of a downtrend shaping up here in this corn market. Next up, crude oil prices just continuing to trade in some wide ranges here after this short covering rally we've seen over the last month or two. This market did see that rally all the way up above 59, pushing up into the prior highs back here in September. We did see a nice rally up towards 66.5, and all week last week we just saw a nice back and forth action here between 62 and the mid 60s. Looking like this might be as much of the upside as we're going to get. If we do see this market continue to rally up here towards 65, 66, 66.5, we should expect to see that resistance continue to hold this crude oil market. Not really expecting a whole lot of sustained upside here. There's not much in this market to be bullish about. This thing has just been beat down over the last 6-7 months here, and this is just a little bit of a short covering rally at the moment. This market remains trading in a multi-year downtrend. We can see here dating back over the last 3 years, this market has just continued to follow this channel to the downside, and we do expect to see the resistance come up here in the top quarter of this downtrend channel. We did see this market rally right up into this area, and we're already starting to see some of that resistance up in this area, kind of like we've seen over the last 3 years here. This market, each time we get extended up into the top quarter of this downtrend channel, we see some good selling pressure come from there, and we expect to see that pattern continue to hold here over the next couple weeks. Not a whole lot for this market to be bullish about, so until we break back down below 62, we could see this thing just continue to bounce level to level here, but we do have a lot of bearish pressure on this market over the long term, so we should see this thing start to slip back down here towards the $60 mark. We have seen this market be pretty comfortable down here in the high 50s, low 60s, so we should see this thing just continue to slip back down into this area. See this volatility start to die back down, as we have seen an uptick in that over the last couple of weeks here. But this might be about all the upside we're going to get here in this crude oil market, barring any major news events. But in the meantime, we should see this thing start to fizzle out and start to slip back down here towards the 60s. In the meantime, though, expect this range trade between 62 and 66.5 to continue to hold. Once this level flips, we should see this thing start to bleed lower once again and settle back down here towards the $60 mark and the high 50s. And last but not least, our equity indexes, seeing some good volatility last week. Early selling pressure got this market pushed back on its heels, seeing the S&P and the Nasdaq breaking down below their 50-day moving averages in some pretty significant fashion. However, we did see Friday with a nice little bounce off of those overextended levels. The Nasdaq rallying back up towards 25,000. The S&P getting back above its major moving averages, but still in troublesome territory here. The Dow continues to be show relative strength, like we've discussed over the last several weeks. If you're going to be anywhere in the stock market, we want to be seeing exposure to the Dow stocks and the Dow sectors. This is going to be where the strength is, and that's exactly what we saw here on Friday. This market holding this opening range low, this yearly opening range. Here we did see those lows holding on Friday right around that 50-day average and seeing a nice strong bounce up into new all-time highs. First close up there above 50,000 as we continue to see good strength here in the Dow index and these Dow stocks. The tech sector continuing to weigh heavy on this market, however, and that's what's keeping this S&P chopping up here in a pretty tight, sloppy range here over the last couple months. Until we can get some more participation from that tech sector and see this Nasdaq start to finish back up here above our major moving averages, we still expect to see some volatility and a little bit of downside, or at least chop here in the Nasdaq and the S&P. Not really expecting the S&P to go anywhere. Look for this choppy sideways action to continue. The Dow should continue to push here with a nice strong finish on Friday. We want to see that hold and continue to push up here into the 50,000 plus area. We need to see the Nasdaq get cleaned up and some of those mega cap stocks see a little bit more structure. We are seeing a pretty messy picture there amongst those Meg 7 stocks. That's causing a lot of this choppy action and divergence here in the indexes. Until those things can get cleaned up, it's going to be a pretty selective environment. Not going to be much in this tech sector that's going to keep on pushing higher. We expect to see this choppy action continue. Now is the time to be selective and defensive here. Reduce exposure to some of those tech assets and be more. We want to keep our money pooled up over here in these Dow sectors and Dow stocks. That's going to be where the strength is going to be. In the meantime, we want to see these indexes clean up and show up a little bit more structure and a little bit better picture from those mega cap names. In the meantime, now is not a bad time to be defensive and raise a little bit of cash here while these other markets are trying to clean themselves up. If you are going to have some exposure to the market, keep it in these relative strength markets and these relative strength sectors. Until then, we don't really have an easy penny or easy dollar environment. We want to see more participation across the general market before we really go all in on this thing. In the meantime, stay selective. Let these relative strength names continue to push this market higher, and we want to see some of these other names in the Nasdaq see a little bit more structure and clean up some of this mess we've had after these earnings releases recently. Before we can really see any sort of sustained upside. In the meantime, we expect to see some choppy action continue here in the S&P and the Nasdaq, and encourage everyone just to be patient, let this thing clean itself up before we really commit to any major new uptrends. That's all we got for this weekend. Thank you everyone for tuning in today. We'll catch you guys tomorrow night for closing comments.